Hi, folks. This is Sean Hyman from The Logical Investor. And I want to start off with one of our positions. It's our Mexico ETF, symbol EWW, because I've been talking about a triangle that has formed. You could really, you could draw it a couple of ways. This would probably be one way to draw it, or you could probably just draw it from, from here. Either way, works out about the same. So this is broken out. It's coiled and broken out above this upper triangle. Now, just know sometimes these pull back and retest the triangle before heading higher, so they could certainly do that. But also know that they tend to go to the upside at least as much or greater than the width of the end of the triangle. So that that would put it back up here towards 52-week highs, 57, 57, 50 at a minimum. So that would put us up to probably new 52-week highs on that. So right now it's battling some moving averages. It has come above the 50-day, but it's hanging out around the 200-day moving average. The MACD has opened up and looking good. There is buy spikes, and the RSI is heading higher. So I said my bias, if I had to lean a certain way, was that there would be an upside breakout. But nonetheless, it could be either way. So we did get our upside breakout, it looks like. Now on the weekly chart, so we've broken. Let me see if I can draw this out. We've broken this downtrend line here. Here's your A, B, C. So here's the end of your downtrend, which culminated with massive, I can't stress that enough, selling. So everybody and their mama dumped this sucker here. Why do we know that? 70 million shares net sold in a week, when normally you're looking at 10, 15, 20 million shares net sold or bought in an average week. So it bottomed there, broke this downtrend line, came up above its 50-week and slightly above its 200-week moving average. But remember, the first time it tackles the 200, whether it's 200-day or 200-week, most of the time it won't go straight through that. Every once in a while, an emerging market one can. Sometimes metals and commodity stocks can as well. That did happen here. It pretty much, it goes through it, kind of retests it, and it kind of hangs out around that for a bit here, breaks on through, and then it's off to the races. So anything is possible, but just know where the price is at right now. It's right around that 200-week moving average. So it'll need to overcome that. Once it overcomes that, then it opens it up quite a bit more. Its next resistance is at 57.24. By the way, if you're on stockcharts.com and you put you click price labels and then click update, it'll put these major turning points and the prices on your chart. That's how I have them. So that way you don't have to follow it across and eyeball it all the time. So 57.24. So once it breaks above that, then it'll be off to the races. So that triangle should take it up to, back to around that region. If it can overcome it, above that, which obviously I believe that it can. Here's your first higher high. Here's your first higher low. So I'm looking for another higher high. So this is likely a new wave 1, 2, and then into wave 3. So we could easily see this go to, I would say minimally 65, but honestly 70, 72 is definitely very plausible. Notice the selling volumes died big time. The MACD picked up steam. The RSI picked up steam. So things are looking good there. So EWW is one that is probably on the move for us now. So I wanted to discuss it first and foremost, since it's a current mover for us. Then I want to discuss our latest one, because some of you may or may not have seen our latest pick. I duplicate the coverage of it so much just to try to help you guys out, but I know everybody, unfortunately, does not view everything that I put out as far as a newsletter or weekly video. and it's unfortunate for them because they miss out on a lot of good material, not because I'm behind it, but because of the types of information that's covered. So Bed Bath and Beyond, BBBY, not to be confused with Best Buy, which is BBY. So make sure you get that third B in there. This one had been in a downtrend for a while and broke that downtrend, retested that downtrend right here to the upside. It's been hanging out kind of somewhat sideways. Really just has kind of a almost like a kind of a flag formation. The flag, this being the flagpole, and this being the flag. You can see it a little more kind of connected over this way. Those tend to be bullish since the move was up coming into the flag. So the breakout tends to be upward. Remember, long consolidations sideways tend to break out into long, strong trends. And this, could easily, come back up to the high 30s or so out of such a long period of consolidation. And so from 21 to where it's at to near 40 would be huge. And where do I get that? You can take the width of that sideways range and project that width from the top of the breakout here, and that takes you up to like 38 to 40 area. So MACD's on a buy signal. Your selling volume's dropped off. Your RSI strengthening. So things are looking good there for BBBY. So that one is definitely perking up. And then let's go back to our first one, GLD. So GLD is still kind of consolidating a bit. This one, is consolidating something like this in kind of a somewhat of a sideways range. You could call it a descending triangle that it might be forming. But this runs up and then starts coiling here. You could also call this, for those of you that follow more technical stuff, this could also be a pennant, which a pennant, it looks like a flag, but it's more of a triangle on the flag instead of a traditional flag look. So this could coil into 5 ways sideways and then break out to the upside. These tend to be measurable by you take the flagpole and you extend the length of the flagpole up. And so, that would put GLD way, way, way up. Matter of fact, you would have to measure it really on the weekly chart to get the full extent of it. But this would have a large move upward. Also, my thoughts on the stock market being overvalued, the tariffs, that are going on right now. All those types of things are pro gold because they're very defensive. Investors take a very defensive posture. At least the smart ones do. The institutions, and so gold is one of the go-tos. So by the way, the ones that kept saying, that Bitcoin is digital gold and it's the gold replacement, and I've written articles and talked about how that is so bogus that you had something that didn't even exist no time ago, and now you've got a unique digital string of numbers, and now all of a sudden they're supposed to be worth thousands of dollars per coin, and there's not even a physical coin. People draw these little circle-looking coins with a kind of a Bitcoin dollar sign-looking thing in it, but there literally is no physical coin you could even hold. So it's silly. And meanwhile, Bitcoin's come from 19,000 down to 6,600, and gold has been heading back up. So Bitcoin was a massive bubble. By the way, India just pretty much outlawed the use of cryptocurrencies, outlawing the wallets, and their banks can't deal with them, and you can't hold a wallet to hold the coins in India. That's billions of people that just took out of that particular market. So central banks will not have a competitor. So it's another reason why Bitcoin was never going to fly. Central banks have been in control this whole time all around the globe. why in the world would they allow something to come up and grow and take their place or compete against it or compete with their power? They have zero incentive to let that happen. So therefore, Bitcoin, doesn't make it. So gold ran up and then has this consolidation, which you have to be patient with because sometimes you get these long consolidations, but out of the long consolidations, you can get long, strong, trending moves. So, once you get mature in this stuff, you realize that to be patient through the ranges because they break out into to long, strong trends. So, for instance, this zips up and then it hangs out for months and then it takes off like its tail end was set on fire and launches. Again, goes from 84 to 119.54, and then consolidates for a bit, some months more, and then it takes off and heads for the next year and a half or so without too much consolidation, a little bit of consolidation here and here. I mean, just really runs up, and then you have your downtrend, and now we're starting the way back up. Okay, sorry about that. I had to go move my Honda Goldwing Trike for my mowers. They want to make sure they didn't get any rock chips or anything on it, so I had to stop the video real quick and go move that motorcycle for them. So anyway, so GLD completed its ABC downtrend here, bottomed here. It broke the downtrend line on C wave right here, and put in a higher high and a higher low, and then we're getting ready to go materially higher. As soon as this knocks out 131-ish and sustains itself above that, this will be a new level that once that is broken above, you'll see a lot of algorithmic traders, momentum traders, all kinds of stuff like that hop on board, and that's when you'll see the trend really propel much faster. Also, remember when I said sideways ranges develop into long trends. So this is technically an uptrend. I mean, you can see the moving average heading up and the lows are getting higher. But as soon as this is broken to the upside, then you will really see this take off. So we spent this has spent quite a bit of time in this consolidation type move, and obviously we haven't been in it the whole time, thankfully. But this next move up will shock a lot of people because people get used to what they get used to. In other words, when this is going down, they never expect it to do this. When it's going sideways, they never expect it to do this. So when it was heading higher, they never expect that to end. So they just always expect what is happening to always continue happening. And that's just the novice mistake. The professional is always looking for reasons why something would continue or change or different dynamics that may be it fundamental, technical, what have you. And so the novice is just never ready for any of the changes. They get caught by surprise. So they've just seen gold as dull and dead and going nowhere and that it's never going to go anywhere again. And it's about that time when gold comes alive and heads back higher. You notice that the selling continues to get lower over time. And the MACD is heading higher, RSI is heading higher. So things are looking good for GLD long term. Then next we've got CHL. CHL has been kind of in somewhat of a range here lately, between 44.50 and 46.65. So it's been kind of around hovering in that range. And it could break out southward before it goes back higher. Remember, I told you on CHL that this one could, if it broke the 48-ish level, that it had a little bit of support at 45-ish, which we've seen it hit, but there was such little support there that it could easily go down to the 35 to 40 area, and that if it did, that would be a great averaging down point. So it never concerns me when a $200 billion company that's already fundamentally cheap, that has a great dividend yield, that has almost non-existent debt and a ton of cash on their books and a ton in earnings, many, many billions, that is, when it gets cheaper, it just means more of a bargain. So that's why I like Warren Buffett, get excited when my stocks go down so I can get an averaging down point and head higher. So, this one is looking better, but it could, this one could drop to 40 or 35 before heading higher. Ultimately, just know that, or it could halt right where it's at. But if it drops, then you get an averaging down point. If it doesn't and it goes up, then you just get profitable sooner and get your return that way. So, this one could easily go back up to the 67.10-ish area, if not much higher. Because this is had higher highs and higher lows. So if the higher high continues, then we would actually have a higher high than the 67.10. But I see that as no problem to reach. And then we've got FXB. So FXB broke its downtrend right in here, has been heading higher. Its 50-week moving average has been trending higher. It's finally come all the way up to its 200-week moving average, where it's been consolidating a bit. So just know that nothing goes straight up, and when it gets around its 200-week moving average, could be one of the times where it comes back, pulls back more towards the 50-week moving average, a little above it, at it, or a little below it, before heading higher and taking another stab at that at that 200-week moving average before heading higher. But here was your last C leg. So you had A, B, C. Here's where everybody and their mama threw in the towel. I love it when there's extreme exhaustion from the sellers and there's extreme emotion from the sellers, because that brings about more permanent bottoms. And so 2.5 million shares net sold in a week, when this normally does 500K or something like that, or sometimes less in a week. So it's nice to see that FXB is continuing higher, but again, we could see a pullback and a sizable one before heading higher. All right, so FL definitely had its ABC downtrend, which culminated in massive selling here to the tune of almost 60 million shares net sold in a week, when it averages probably 20 or less. Bottomed and zipped up to its declining 50-week moving average. With both these averages still declining, I believe that there's a huge chance that this ultimately heads lower before heading higher. Now, it doesn't mean temporarily it could head a little higher before heading lower and then higher, so stocks can act weird. And of course, it could totally buck the odds altogether. But it's why I believe that there is, one more push lower, even if this goes higher for now and then does a three-way pullback lower before heading higher. I still believe that it comes ultimately lower and tags our buy signal. Should it not, again, no biggie. We've got plenty of other stocks to choose from, so we don't want to chase them. So that's all I've got to say on FL, especially since we're not, filled on it, not a whole lot extra to say. We already covered EWW, so then we're on to GDX. So GDX has a lot of support around the 20-ish area, 20 and change. Hit it here, came close to it here, and here. And so, so far that is this holding well. If you look at GDX on a weekly, this one completed its A, B, C downtrend, and we know that by connecting these high points across here. And we also know that the selling volume continued to build up till this point, which is likely the bottom of a wave 2. Remember, selling tends to peak anywhere towards the end of wave C or towards the end of wave 2. So we probably got a 1-2 here. If so, that means that this 1843 is another ultimate low, which is higher than the 12s. If that's the case, then this range here, which has been long, will break out to the upside and make this look like chump change. So we'd see it go 40, 45 very easily. Which would be a doubling for us. So, and keep in mind too, if for any reason this is a larger A, B, and then C, where this comes back down and retests this, then what does that do? This drops from, 21 to 12s or something like that. Then it gives you a great averaging down point on, some of the largest gold miners in the world. As gold is strengthening in price, it's bullish for gold miners. So I don't personally think that this breaks out to the downside before heading higher. I think that it consolidates sideways and heads higher. There's many reasons why I think that. You've got the RSI that's continued to strengthen higher. You've got the selling volume, which has continued to plummet. You've got the MACD, which has continued to head a little bit higher. So there's a lot of reasons. The 50-week has crossed the 200-week, and these have gone from down to more sideways, building a base, and then so I think this is going to head higher into a new high above 31.44, and I think this could easily hit 40 to 45 at a bare minimum. Could go much higher, and so at around those levels, we would be at at around the 46, 47 level. We would be at a double. So that would be huge for us, but definitely very bullish on GDX. And again, it's another one where something has moved sideways for a long time. So investors don't expect gold stocks to do anything. They think they're dead in the water forever. That's the mentality. I can tell you that anytime something's been some way for a long time, that's exactly the way they think. And they're convinced of it and they use that as their evidence. Just like when this was heading down, they never thought that this would ever reverse. When this was heading higher, it could do no wrong. It would never reverse downward. But when these trends reverse, and we can know that by trend lines breaking, by knowing Elliott wave counts, A, B, C downtrends, and the trend line breaks up. We can know that by selling exhaustion, which we see here. I mean, this selling in here is so much bigger than at any time in the last decade, and that selling has dropped off considerably. So there's a lot of things that if you know what to look for in the charts, a mature eye of the chartist, of the technician, can really help a lot. And so you don't have to be one of those. That's what I'm there for. Having watched markets for 20, 25 years, that's my deal. So on LPL, which is our next one, and it's actually our last one because I've already discussed BBBY. So you got an ascending triangle, not an ascending triangle, a symmetrical triangle that's something like this. These lines are a little bit of an art, and as much as they are science. So they're just general regions, and these tend to consolidate, bounce back and forth, and then once it gets towards the narrow end, these almost never go completely to the peak. In other words, you'll never usually see draw these lines out into the future, and the stock just totally go until it can't squeeze anymore and then break out. So they tend to break out about 2/3, 3/4 of the way through what would be a completion of an actual symmetrical triangle. So that's why I think there's a good chance with this having all these years of doing essentially nothing, consolidating in this area, for it to really, for the first time in many, many years, almost a decade, do something it hasn't done and be the shock and awe of a lot of people, as this has done an A, B, C, which could go deeper. I mean, this could go, back to 10 and then on up. If it does, then it gives you an averaging. And when this thing breaks out, I mean, this thing could go 25 to 30 very easily, and it could be far, far greater than that when you see a consolidation that's lasted this long. I mean, it could be something ridiculous. It could go up to 50 or more. But the MACD has been improving a bit. The RSI has been improving a bit as well, and so this could stop anywhere. I mean, it could stop where it's at right now. It could go down to 10. Could it go further down and go to some, previous support? It could. Rarely do they do that, but occasionally you'll get fake outs to where something will will do a head fake and go down into the support that's at the eights, and then then go higher from there. That could happen because you do have this basic support region right along in here. So yeah, any of that can happen. So just know in the near term this could go to 8 or 10, but then long term I'm looking for breakout to the upside. The fundamentals are solid and cheap. It's been consolidating for almost a decade, and I'm looking for a turnaround on that almost nobody is looking for, and I believe that it will do very well. So that is it for this week. Again, let me look at one other thing. Sorry, I want to look at the general market. So when you look on the weekly chart, the longer term trend line hasn't quite been broken yet for the S&P 500. The more aggressive trend line, which is where it really picked up the momentum, already has. So typically that would denote a top when the market really takes off and gets far away from its even most aggressive trend line. That typically is the top of a wave 5. Now we don't know if it is for sure yet. It's going to take some time to tell that. The price is going to need to break below this trend line. It's going to need to break below the 50-week moving average. It's going to need to start holding below the 50-week moving average, and that moving average to curl downward before we really know that's the case. So tops are known a bit in retrospect, but we do know that this has a toppy feel to it, and we know that the fundamentals, the PEs, etc., are at historical highs. We also know that the MACD has had a hard sell signal here, and it's well, you would probably actually draw it more like this. So this is starting to break a trend line there, which is bearish. This RSI, which had been increasing and getting stronger, has broken down lower. So there's a lot of things that are showing weakness in the RSI and MACD that is showing that this is likely to head down further. Now, with that said, that does not mean that this has to head straight down. This could have a bear market bounce. There's all kinds of options that could happen here. You could have this just bounce up to somewhere around this declining 50-day moving average and head lower. That's probably the most likely scenario. But you could have it come up to right in here, 2,800, which was this previous level here, or you could have it come fairly close to matching the old highs, and then heading lower. Any of that is possible, so just know that. We do have declining RSI, so that's bearish. We've got a very big divergence. Well, I wouldn't say divergence, but a negative signal on the MACD with getting lower highs and lower lows on it. So what's going to really trigger a lot of sell-off is, let me erase all that and just go back with once. Let's see here. Once this area right in here has been broken, this 2550 to 2575 area, once that's broken below, that's when you're really going to see the downtrend accelerate and gain some steam. So this is where the last sell-off stopped. You've also got the 200-day moving average around that, and you've also got a consolidation period right back here as a general area of support. So once that's broken below, everybody that's owned and bought and held this index for the last so many months are all of a sudden all underwater. And by the way, here's how this works. When something starts accelerating very rapidly, and it seems like day after day after day almost, it keeps going up, that's when it sucks the most people into the investment. So a ton of people, guarantee you, just because I know how markets work and how market participants work, ton of people bought a ton of the S&P 500 in this region here. So they're already slightly down on their money. However, buy the dip has worked for the last so many years. So they're programmed to just keep buying the dip. They think that, this will be like none other and we go into new highs. While I can't exclusively rule that out, I mean, hey, if this did go to new highs, it just means the PE's got that much more expensive, and the risk of a massive sell-off just got even that greater. So, but with this 50-day moving average turning down, and with these violent sell-offs, and with the sell spike starting to pick up, and the MACD and the RSI looking so bearish, we could be in an inflection point here, and starting the beginnings of a downtrend. But we won't really know that until we get another major low lower than what we got here, because these are somewhat equal in their bottoms. So we've gotten a lower high than here, but we haven't really gotten a lower low than here, because this one was equal to it. So this could just come straight on down, and break through it, or it could come up like I talked about to here or up here and then come lower. Those are the most likely scenarios. But when this breaks through here and clears, let's call it, 2550, for sure 2500. I mean, it's going to unleash the beast, so to speak. The program sell orders, the algorithmic traders, the bears will just gain confidence big time, and they'll pile on, whether it's electronic orders that are done by computers or whether it's human big short sellers in the market that are hedge funds and large institutions. So that's when it'll get really, really rough. Also, another thing to note too, the other day, somebody was talking about how, the Dow had gotten below its 200-day moving average. Well, one, it didn't close below it. And also, just because an index goes below it, you really need to look and see further confirmation of other indexes being below their 200-day moving averages too, as far as something being truly bearish. And it needs to hold below it, not just dip below it, a day or two, but something that starts to sustain itself below the 200-day moving average tends to be a trend change. So, the Dow isn't quite there yet, and we looked at the S&P 500. It's not quite there yet. It closed one day below it, but then it came back above it the next few days. So again, that was just very, very temporary at this point. The NASDAQ composite, has just barely come close to it. It's had some of the biggest sell-off here lately, but it hasn't still, it needs to take out this low here. It needs to take out the 200-day moving average, head below it. So once it clears, probably starts closing below 6,700, then we'll start to see that sell off even worse. And again, there's commonalities of RSI getting weaker, MACD getting weaker, saying that your upside momentum is getting worse, and that in other words it's slowing down. You've also got the most aggressive uptrend line has been broken as well. So there's a good chance that it just comes up to the 50-day, or maybe where the downside of this uptrend line would be retested and head lower. So, again, don't be fooled by rallies up in this market, because a lot of that's just, short covering and things of that sort. But you'll find that bear moves downward have sharp rallies higher, and people can confuse those with being bullish, and they're not. So just know with the PEs where they are, the RSI and MACD acting like how they have, some of the most aggressive trend lines being broken, those are all bearish signals. And so you really should not put a whole lot of weight in the up days that the market has now versus the up days when it was still in a bona fide uptrend. And by pretty much any measure, it was still there, even though it was overvalued fundamentally and dangerous fundamentally. It was still technically in its uptrend, and it was not long for to probably be rolling over, and we could be in that period now. I don't encourage shorting. Just know that. Don't short the market. Savvy participants may do inverse funds, or buying put options on the S&P 500 or something like that, and that's fine. But just know that's a lot more aggressive. I would rather somebody hold large chunks of cash and use that money to invest in 2 to 3 rounds when the market has massive drops. So for instance, if you're just looking at the S&P 500, if the S&P 500 dropped down to 1800, you put in 1 round. If it dropped to 13, 1400, you put in another round. If for any reason it dropped down to 1,000 or 1,000 to 600s, anywhere in that range, you could put in another round. And then your average break even is so low that any turnaround, it wouldn't have to get anywhere near its old highs, and you could make quite a bit of money. So that's really how I would rather somebody deal with an overvalued market. Deal with it opportunistically with a lot of cash on the side, and allow something, be patient, allow something to go way down before you ever even think about investing again. So, this is so overvalued that this will come from 2,900 to 1,800, and we'll probably just be back at a point of fair valuation. And bear markets don't stop at a point of fair valuation. By the textbooks, maybe they would, but in reality, they don't, because human fear and emotion is involved. So it gets driven down to a deep point of value. So it wouldn't surprise me if the market ends up falling to the 1,000 to 1,400 level right in here. So, and that's a major point of support. So if you take that area into account, this could easily have a massive ABC that unfolds down into that region. So just know that. So and downtrends tend to fall way below their 200-week moving average. So it's why you wouldn't even want your first round to happen until this got close to around the 1,800 level for the S&P 500. Like if you were investing your 401k money back into the market, and then your next round you would probably want to be around 1,400, and then your next round 1,000 or below. And so that way you've got a very low break-even point on your money. If you get all your rounds invested, your break-even might be around 1,400. Well, you can imagine if this just comes from 1,400 back to the lower side of this 200-day moving average, which will have declined some, you would still be at a very nice overall market-beating return, and you wouldn't have the risk that is associated with shorting a market. So anyway, just a little food for thought there of having cash and being patient and strategic with your averaging downs versus the risks of shorting. Okay, thanks so much for watching, and God bless. Bye-bye.